Hi, welcome to another episode with BasisPointInsight.com. Today I am joined by a good friend of mine. We've been friends for nearly 30 years now. He's an investment veteran. Currently, he is the MD and CEO at BugleRock Capital, a wealth and asset management firm with over 42,000 crores of assets under management. He is a dyed in the wool market expert, not a bit shy to come out in the media and talk, but he's gracefully agreed to speak to me. Thank you, Manoj, very much. Let me start this conversation by asking you, is geopolitics creating too much of noise around investing and people are missing signals? Or is it that geopolitics is the signal?
So thanks, first of all, Katie, to have me here. It's a pleasure to speak to you, which we keep doing regularly. Now, coming to geopolitics, yes and no. But given the way things are happening today, especially the kind of wild things that are happening around the world, geopolitics has become a lot more important, and everything is linked to each other. Uh, if you look at the US today, uh, go back 3 years from now, everything started when Russia invaded Ukraine. That is when the geopolitical scenario went for a toss. Why? Because till then everybody thought that it's safe to keep money in dollars. Western countries are the ones which will lead the world and stuff like that. But after what happened to Russia, especially, they had a lot of dollar assets which got frozen overnight, and post that, every single country, whether it is from the NATO side, whether it's from the BRICS or wherever, started thinking that, hey, is it safe to just be, aligned to US dollar and stuff like that? So now each one of them is playing their game separately. So I think it's only a matter of time when, normalcy sort of comes in, and then geopolitics doesn't matter much. In between, there was also the Israel Iran war and the oil prices going up. So all that. So I think too much of noise is there, but of course it drives both the currency markets, the equity markets globally. Also, it plays on with the tariff regime that Trump has gotten. It's gotten a lot of uncertainty. Yes, it is very important to just answer your question.
So let us talk about tariffs. Do you think if the tariff issue is resolved, things will be back? Look at India. We are the countries today. The markets are trading at a 50% premium to other emerging markets. Right? In dollar terms, the returns are really negligible in that sense compared to other markets. So then, when will this issue get resolved?
From a valuation perspective, if you look at it, 2023, we were at 100% premium to the emerging markets. So, which means between 2021 and 23, the markets in India had outperformed so much that the premium was almost 100%. Over the last 2 years, which also explains, the premium has dropped from 100% to almost about 47 or 50%. And if you look at it, if you look at the past averages, how the premiums have played out, given the India growth story and stuff like that, we have always traded at 50% premium to the emerging markets. So trading at a 50% premium is nothing new. We had gone as high as 100% 2 years back. It has corrected in the last 2 years. Now, why it has corrected? There are two, three reasons. And whether it is still sustainable or whether it's going to come down or go up, time will tell. But there are two, three big reasons why the premium has corrected to where it is, which means the markets have not given any kind of a return in the last 2 years. So first thing is that FIIs have been consistent sellers in the last 2 years. Now we can try to analyze why they have been selling and stuff like that. One is when they started selling around 24, India was the best performing market. They were making a whole lot of money. There was this war between Ukraine, Russia, Israel, so all that was happening. The best way to get into some cash is the best performing market. So by virtue of being the best performing market, we suffered. Initially, the money went down. The second is also the carry on after that was that US over a period of time also realized that their debt is going up, $37 trillion as we speak, $2-3 trillion getting added every year and stuff like that. The only way the markets thought that the US will be able to get over it is devalue their currency over a period of time. And actually, against cross currencies, US dollar started depreciating. Unfortunately for us, while we were the best performing market till 23-24, and the money went out, to complicate it further, Indian rupee started depreciating against the dollar. So we were one of the two countries which started depreciating, and the rest of them in the BRICS and otherwise, including euro and pound and all that, started strengthening. So India depreciated almost about 6% last year. That is INR. And the only other currency that depreciated is Indonesia rupiah. So given that, obviously the dollar returns would have been given the growth and stuff like that, would have been marginal or almost nothing being there. So the money is actually moved out of India by the FIIs, and it went to markets which actually could offer them a better return.
Just taking off from that question, that I mean the point that you said that FPIs did pull out money. I was speaking to some other market folks. They were saying that actually India, in some sense, not completely, but to some extent, funded the whole global AI chase. The whole chase that went after all the AI stocks and hyperscalers. They saw more opportunity there, and so it made more sense to exit India, take the money out, and go and do that. Could that be some reason? Very quickly.
That was my second reason. So basic thing, and that's also a positive for us going forward. Katie, this is a very important and a good question. See, if you look at it, one is dollar returns were not there. So, and we were the best performing, markets in the past. The third is we had nothing to offer on the AI side. So we were a contra trade. The money went out of India chasing returns for the flavor of the of the markets, which was we had nothing, absolutely nothing. Small time here and there we were doing things. However, even a country like China, in the last 1 year after their DeepSeek announcement, a lot of money moved into China. So if you look at it, Chinese markets have given 40% return. See, all the markets that were AI driven, which is South Korea, Taiwan, China, US, all these markets went up. So obviously, that is the third reason why the money moved out of India, which was a sort of a contra trade which can benefit us going forward. I just want to update on that. As much as the money went out because of the AI trade, which we didn't have anything to offer, going forward, if you look at reports coming out and stuff like that, whether the AI driven stocks, whether the valuations are sustainable, returns are going to be there, whether there's going to be a crash and stuff like that. Again, I was talking to a fund manager who was talking to a principal from the US, were allocating money into India not so aggressively in the past. I have started talking to them saying that, hey, India could be a good contra story if and when the AI bubble breaks, if it breaks or if there is a correction, then India is a safer bet. So probably India may not fall as much as the rest of the world. While we will fall, but it can be a cushion for investors and the insurance against the AI trade. So that's the positive way of looking at things.
So how do you, all right, fine, which is a fair point. There was a lot of money to make in the small cap and the mid cap segment. It went through the roof. Uh, the earnings are not justifying it. The valuations have come where they have come. Now, what has to happen? Should earnings recover, or will just liquidity again come back and say, okay, fine, this is still now valuations are beaten down, let's chase it again?
So, KD, if you look at it, we have three broad indexes. We have the large caps, which is driven by Nifty, BSE, Sensex. Then you have the mid cap and you have the small. Now, if you look at the valuations today, large caps are almost at about the last 10-year average on a trailing basis. Mid caps are at maybe about 25-30% premium to the averages. Small cap is at almost 50% premium to the last 10 years average. So which means just looking at the P multiples, yes, mid cap and small cap looks overvalued. It is looks expensive, whereas large caps look not cheap but reasonable. So it's at the average. Now, given that this is the way the P multiples look like and the valuations look like. Now, what can drive and what is driving these segments? So, if you look at it, number one, the markets are a slave to earnings. So, you have to know from if I'm able to gather from Bloomberg and stuff like that, is they're in high single digit or low double digit. Now, mid caps, of course, the last quarter was something great, but the projections, what we see is anything between the 12 to 16%. Whereas the biggest worry is that where you have a 50% premium on the 10-year averages of the small cap, the earnings are expected, the earnings growth expectations are anything around 4 to 6%. So, which means you don't have growth visible. So, obviously, my advice to people is to avoid small cap, to some extent mid cap. In certain pockets of mid caps, there can be opportunities bottom up, or even with a higher valuation because of the growth potential. There can always be opportunities in the mid cap space. And for a very, very long term, sleep well kind of a person, large cap is the place to be. But yeah, small cap, we are completely underweight.
Correct.
Not
So now let us,
not now. We've been underweight for the last 1.5 years.
right. So let's come back to one of the other favorite sector that Indians like, real estate. What is your house view on real estate? How are you guys positioned?
So, see, real estate, you have to take it along with the growth of per capita GDP and other stuff. So, if you look at real estate in the past, say maybe you go back 10 years, 20 years, 30 years, and stuff like that, most of the families were joint families. So not much of a demand was there from as nuclear families. As you look at it in the last 2 decades, most of the joint families have split. Split in the sense for good. People have become independent, husband, wife working. They're able to leverage, buy apartments and stuff like that. So the actual demand has actually increased in the last 10 years, and that demand is going to be there. However, very interesting thing is that affordability is very, very important. If the prices go beyond certain levels, then automatically the corrections will come. Demand will be there, but if the prices go as very, very high, then people will wait for it to come back. They will rent it and stuff like that, and then come back to do that. But having said that, the way one was looking at real estate in the past and today is completely different. Today it is actual demand. Maybe 20 years back, 30 years back, it was always uh, alternate investing stuff where everything and anything was possible, right? So, people would today, everything is so formalized, whether it is income tax, GST, everything is accounted, digitized, and all that. So, in the past,
So what do you? So within the whole real estate space, what do you buy? Do you buy companies who are focused in Bombay, which is the gold mine for real estate in terms of pricing, and maybe to some extent affordability? I wouldn't say completely. Or should they look at players who are diversified and who are there present in multiple cities, or forget all that and just look at REITs?
see, Katie, as I said, today real estate purchase is for actual use. It is not for investment. So any city that is prospering and growing will see need for real estate. Like I sit out of Bangalore. I am told the biggest and the highest launches happen in Bangalore because of course you had the IT sector. Now you have the defense, the drones, the deep tech. The demand for things will continue to be there. Among all the places, what I hear is Hyderabad is the hottest place.
Okay.
Again, see, the reason is Amazon has put in their largest, center in Hyderabad. Now Google is talking about putting in Andhra somewhere and stuff like that. So as long as large companies come in, the GCCs come, they put up stuff. So I think places like Hyderabad, Bangalore, Pune, even Chennai, these are the places which can attract the mid end of the real estate. The high end is typically, if you look at northern markets, you have Delhi, Gurgaon, and Noida. And you'll be surprised. Yesterday I was, reading a report. Delhi has almost no launches or the number of flats sold is very very limited because it is not there, not affordable. Mostly it happens in Noida and Gurgaon, and in Gurgaon it is super premium, and most of the people are now moving into Noida. So any place which is giving them good infrastructure and growth in terms of the local economy, the industry doing well, and all that, it will continue to grow. And of course, the lastly, affordability is the most important thing, and interest rates are also a factor. If the interest rates comes down, then obviously on the leverage side, it will be a lot more affordable for paying the EMIs and stuff.
So I see that you didn't answer my question directly on whether Bombay or you should buy uh, builders who are spread across. That's all right. But let's move on to the next side of assets, which is fixed income. What's your view on fixed income?
See, fixed income today, there are two, three categories, unlike in the past. See, I come from an era when I started my career. Corporate debentures used to give 18 to 20% returns. I think you have also seen. We have seen it together.
Yeah.
And then the interest rates have started coming down and stuff like that. So the only options that people had in the past was, fixed deposits, not very tax efficient, and then you had bonds where you would get the or debentures where you would get the coupons and stuff like that. And then came the mutual funds, and within mutual funds there are multiple categories, from the liquid funds to income funds and stuff like that. So now there are better and a larger category like what it is available in the rest of the world. So I must say here that if there is a smart investor, and given the way the equity valuations are in India and growth expectation and all that, if somebody can take not like a equity kind of a risk, but a slightly higher risk on the fixed income side, they're able to get a double-digit return on the private credit. So, given that, one
All
thing
right.
is that to answer your question, view on the fixed income, I think the high interest rate regime is behind us. The rates would remain as is or may come down based on what US is going to do. Because the reason I'm telling this is if US stops cutting rates, India will also, even if they want to, they did it last time, but they will also stop cutting rates because as it is, there is an outflow of AFIs and negative returns for dollar-based investors. They would not want to start aggravating that. But given that, my sense is that both whether in the US or here, forced or otherwise, in the US, interest rates are likely to go down. So we are advising our clients to stay invested in the accrual kind of strategies or the short-term strategies, and to some extent a small portion in the longer end of the yield curve. That is for safer investors. That's the portfolio. But for clients who are wanting to put money in fixed income and want better return than just these funds and bonds and FDs, willing to take a slightly higher risk. There are a lot of the performing credits and private credit funds that have come in, which can give anything based on the risk what you take. You can expect anything between 7 to 12, 13% post-tax, post-expense kind of.
Great. So before we go off, how about another nice, good asset that we all love, gold? what is the? I know you have been talking about gold for a long time now. I know it's not fair that I ask you now because you have been bullish on gold a while back. What do you say? Should you go long on gold even today?
See, one is I always believe that investor should do his asset allocation properly and should have adequate exposure to all asset classes based on his needs, return expectation, risk appetite, etc., etc. So I think that is on one side of it. The second is coming to gold. I will add silver also beyond gold, and which is what uh, we have been, recommending for the more than I think 1.5, 2 years from now. Initially, it was only gold. Last 7, 8 months, silver. Now, again, a lot of people keep coming and asking that, hey, gold has doubled. It's almost given in the last 1.5 years more than 100% return, and silver in the last 1 year has given about 60% kind of a return. What do we do now? Our view is like this: we continue to do our asset allocation as per client's requirement. However, and wherever clients don't have any exposure to gold and silver, even at current levels, we are staggering our investments. And we believe that we are in a structural bull cycle for the commodities. And when I say commodities, precious metals and non-ferrous metals, including the likes of copper, zinc,
All
like
right.
that. So our premise is based on only two, three things. We believe that given the way US has built their debt, which is close to 37, $38 trillion, and this is if you look at the playbook of various regimes in the past, which were reserve currencies and all that. The first red flag for any country before it starts falling apart, and for the currency to fall apart is debt to GDP. And every time in the past, what we have seen, it's happened almost 52 times in the past, in so many years, is that whenever the debt to GDP has gone above 1.3 times, 50 out of 52 times, these countries have defaulted on their payments. The currencies have got devalued, and alternative currency normally drops. Now, I'm not telling it's going to happen today, tomorrow, 5 years, 10 years, whenever that will happen. At some point of time, it should happen. If that happens today, unfortunately, there is no alternative to the US dollar. Now, if there is no alternative to US dollar, what could be the future and how does the currency market look like? So we believe that it will be till such time there is a strong currency that can come up, which we don't see anything on the table today. We believe that it will be a multi-currency regime going forward. Dollar also could be there. It will not break away so easily. But
Right.
in the interim, when there is a transition from a US dollar to a multi-currency or to a single currency and stuff like that, what is the currency that people would want to use? And we are slowly seeing things happening. We believe that till such time, the currency gets, once somebody is able to look at which currency is going to be the next one, I think and we believe that gold can act as the reserve currency, which otherwise people were looking at it purely as a asset class. So
All right.
which means what will happen is India trades with Saudi Arabia. We pay in rupee. Saudi Arabia at some point of time says, "Hey, I have more than enough INR. What do I do? Let's settle this trade." Then the net settlement possibly can happen in gold. So, which means and that also explains why most of the BRICS countries have actually in
Countries.
the last 2 years increased their gold reserve vis-a-vis the dollar reserves, and the dollar reserves have actually come down. So, my belief today is that if in the past, when gold and silver have gone up and stuff like that, it was purely speculative. Uh, Operators have operated big banks and big hedge funds and stuff like that. This is the first time that the central banks have been consistently buying it. So, which means gold will continue to remain and act as a reserve currency. And the second, before I hand over, is on silver. Silver, unlike gold, is a perishable metal because it is 60-70% of the silver is used for industrial purpose. And it
Right.
has increased significantly in the last 5 years with the advent of EV, with the advent of all these defense, manufacturing and things that are high-end stuff going, robotics and stuff like that. And what I read is that silver, from whatever that is mined, there is already a shortfall of about 20-25%. And there is already a price difference between the paper silver, which is the ETFs and stuff like that, which quotes in the Western world, and the actual silver price when you go to the bullion market and buy the silver. So the spot market is already trading much higher than the paper market. I don't know which one where it will converge, but we believe that as long as the shortfall is there and restrictions are there for export from China and a couple of others trying to hoard silver and stuff like that, we believe that based on one's asset allocation and risk appetite, one should fully stay invested in gold and silver to the extent of asset allocation they want to do there. And we believe that it will be a good hedge against the dollar if the dollar corrects. And also, it's also a good hedge against your first question, which is the geopolitical risk.
Right. So, dear viewers, if the man who manages over 42,000 crores in assets, if you have heard him right, let me also again distill what he has said. To sum it up, Manoj Shenoy is bullish on large cap equities and fixed income. He believes there are opportunities in uh, private credit, right, Manoj?
Yeah.
And of course, gold and silver is a must in everybody's portfolio. Thank you very much, Manoj, for spending time and sharing your insights from where you sit. Thank you very much.
Thanks, Kate.
Dear viewers, it is a pleasure interviewing Manoj Shenoy. I hope you stay logged into more episodes of BasisPoint Insight.com for similar episodes on investing. Thank you.